last week ended at a stalemate between the bulls and the bears at the European energy markets, and this week we are working with really clear support and resistance levels that would tell us who is coming out on top. Hello everyone, my name is Marcello Kolacs. I'm the managing director here at Clever Markets, and I am walking you through the European energy markets for the week starting 7th of July 2025. Before we get started, of course, as always, here a little disclaimer: everything you see here is just my humble opinions and of course does not constitute trading advice and is also not an invitation to trading. Okay, let's move on. The Clever Markets dashboard this week is starting out rather neutral, with nearly no exceptions except the JKM that is already heading lower and the Henry Hub that retains some bullishness on the daily chart. So you can see here on the TTF, NBP, front month and front season products, German power, EUAs, Brent, everything is rather neutral. So what are we waiting for? The supply and demand balance in a few key countries in Europe remains balanced. So we do have a Troll maintenance extension, but the impacted capacity was lower. We did have solid wind generation and higher LNG sendouts from terminals. Yes, the LNG schedules has decreased just a little bit for the week ahead, but really, what remains the key concern are the tensions between Israel and Iran. When I was talking to traders at the end of last week, it was truly tensions in the Middle East that kept the price a little bit elevated, and for them there was still a chance for the conflict to kick off again and also pull prices higher. At Clever Markets, by the way, we believe that European energy markets are rather set up for a decline, however. So let's see what the market thinks broadly. Every week I'm asking my LinkedIn network where they think the European energy markets are going to go next week, and what we had for around 2 weeks now is a fairly balanced market. Can you see the bulls and the bears are evenly split, 40%, 38.5 for this week, and last week we had 35.5, 31, 26% are indecisive. This week it is 21. So the market is split, and all of this fits perfectly together. So we do have a supply and demand balance that wouldn't really invite any strong trends. There is uncertainty between Israel and Iran, so nothing is happening there right now. It is reflected in the TTF sentiment poll, and also the price itself is moving within a clearly defined sideways range that, if at all, is best traded on the hourly chart. So right now it's all telling us neutral. However, I think it's important that we are still working with some very clearly defined levels that will tell us when the neutrality is no longer playing out. So you can see we have here the TTF front month, we have the NBP front month, TTF front season, NBP front season, we have EUAs, German power, Henry Hub and Brent. And we can see all of the markets after a big increase from 11th of June towards 20th of June. Of course, that was when the Israel-Iran tensions intensified. We had this big drop when we had our first very fragile ceasefire agreed, and the big drop itself shows me that the market was set up to move lower. And also we talked about it over the past couple of weeks when it all developed. So the price was pushing higher and we were already expecting a decline, but of course what we didn't expect was the big drop. But this big drop is showing us that the market was really unhappy with the elevated prices on the TTF, for example, towards 42.44. That seemed a bit unreasonable, unsustainable according to the traders, and they took just any bit of bearish news and they really ran with it and saw the market decline significantly. So what we're doing right now, and you can see how everything is a little bit in a stalemate, especially Brent, and we haven't seen a lot of movement on a lot of the key contracts. So let's move into the details and just go through the markets step by step to see what would actually cause us to have more of a bullish or bearish view. So on the TTF front month, of course, I'm starting with the weekly chart, and here we see that last week ended after this ginormous drop. We ended the week with a doji candle. So this candle essentially shows us that the market or the week opened. Then we had a little bit of an upside movement, a little bit of a downside movement, nothing crazy, and we ended up where we started. So this is a good sign of indecision essentially. We're also not really getting any new signals on the trend tools, on the momentum tools. So this here is the MACD, right, moving rather sideways. There's no big signals on the stochastic as well. I mean, we did top out in neutral territory, which is usually a sign that eventually favors bears, but right now nothing is really happening. So what we are doing on the weekly chart is we are marking out the boundaries of last week's range, and if we get a push below 32.76, then the bears are more likely to continue, and if we get a push above 34.5, then the bulls are more likely to continue. But our preference is still with bearish continuation, and a lot of that has to do with the daily chart. So on the TTF daily chart, we see that just recently we broke below the ascending wedge, and ascending wedges, I mentioned previously, I'm not going into all the details here again, are super difficult to trade. So in comparison to a normal channel, we are not working with clearly defined levels. So in a normal channel, we have very clear entry points and timely entry points as well. And we kind of know that the market goes until the upper end of the channel before declining again. So you can start trading the smaller swings as well as the broad direction. And when the market breaks out of a channel, oh, that's a very ugly channel, then we also do get very early signals that are sometimes earlier than waiting for a lower low and a lower high. However, on a broadening wedge, we see that both the bulls and the bears are increasingly confident of their direction. And of course, we can't just wait. We can't just wait until we break below this level in order to start a short trade, right? Or of course, we can't wait until we push above this level here before we enter more on the long side. These are like ginormous distances that are being covered. Can you see from here to here? And you're telling us to wait until here, so realistically from this candle to enter short? Of course not. This is not how broadening wedges are traded. Usually they can start out as a normal channel, but when this thing here happens, we really have to zoom in onto the smaller level time frame. So in this case, for this the daily chart, so the hourly chart would be fairly useful, and we would simply start to enter at the peaks and the troughs as if it was just a tiny swing trade, and we just leave this open, or we are even more inclined and willing to keep the trade open that started here or here, and then we just go with it as the market pushes past it. So hopefully this way we would be able to catch more of it. Now in reality, we did have this big gap. Nobody could have anticipated that, but it was showing us that the market was very willing to move lower, so a break below the ascending broadening wedge was more likely. What has happened since then? Sideways. So we are working with this Fib retracement. We put a 0 down here and we put the 100 up there because we are now thinking, okay, a move above the 23.6% Fib retracement at 34.95 would launch an upside correction. However, by the way, this doesn't seem very likely right now, but we've got it there. And Fibonacci retracement levels, they're all telling us something very specific. So anything below the 23.6% Fib is just considered noise. So eventual downside continuation is most likely if we remain below 34.95. If we break above 34.95, we would be dealing with a shallow corrective move higher. What would happen then, since this year has advanced so far? I believe that the 38.2% Fib retracement kinda aligns with the old broadening wedge boundary. So in this case it would be a pullback resistance that, if it holds, would simply continue the downtrend afterwards, and the bulls would only be in charge if we push higher. Then of course we do have the 50%, which is somewhere here. 50% is not a fib number in itself. It's just the halfway point and usually quite important. Usually deeper corrections at the maximum, they do top out at the 61.8% fib retracement. So in our case, the 38.7. I don't see this happening right now, but there is a chance. There always is. But honestly, first, let's keep an eye on the 38.2% fib retracement at 36.38. If we even make it past that, because then we could see something like this. So a little bit more sideways, a little upside correction. We are finding resistance at the fib and at the broadening wedge boundary before we continue lower. But for now, honestly, probably a little bit more sideways at the start of the week in the absence of new supply and demand factors, and then we push lower. And we would know that the sideways range is resolved below 32.64, which is also the trough here. Why do we think that the bears are more likely to continue? Well, we see that the momentum, although the market is pushing a little bit sideways, the momentum, as shown on the MACD, is still firmly bearish. We're also seeing that on the DMI, so the directional movement index, we see, so the tool consists of three components. We have something called the DI minus, the directional index minus. We have the DI plus, the directional index plus, which denotes the bulls. And we have this white line here, which is called the ADX, the average directional index. Now, if the ADX is below 20, so 20 is up here, that means if we are below 20, that means the market is not trending. And that usually would also mean that the bears and the bulls are both pointing lower. And all of this is the case right now, right? So this shows us that the market is neutral. Below 20, that's the first filter. Yeah, so always look at the ADX. Are we above or below 20? If we are below 20, that means the market is moving sideways, which means we can kind of ignore the red and the green lines, the DI plus and the DI minus. If we are above 20, that means we pay attention to which one is above. If red is above green, that means the market is bearish, and if green is above red, that means the market is bullish. But anyway, in this case, we are below 20 on the ADX, so we ignore the rest of the tool. So, and that is also perfectly reflected in the market itself, right? We have been moving sideways for a week. However, we see that the 8 and 12 exponential moving averages are still bearish, and also the slow stochastic is not giving us any sort of like bullish signals. So what we could expect is maybe the ADX to give us a bullish signal now that the market pushed higher a little, or not didn't push higher, but now that the market found support at least at the 32.64. So it would be reasonable to assume that the slow stochastic would give us a bullish signal with a move above the 20 level, a move above oversold territory. Not happening. The bears are still very, very happy where they are, so also here downside continuation seems more likely. Now here's the thing with the stochastic. Moving into the extreme territory, so moving into overbought territory, moving into oversold territory is not the trading signal. The trade trigger would only come if we push above oversold territory, that would be a bullish trigger, and if we move below overbought territory, that would be the bearish trigger. Here, let's have a look, right? Last time we had a, oh my god, there you go. Last time we got a bearish signal on the stochastic was exactly when we started forming this bearish engulfing. So even before the gap, we kind of knew that the market was set up for a decline. Did we get a bullish signal at any point? Ah, yeah, here, there you go. Here you can see that we did move above oversold territory into neutral territory at this point in time. And what happened? That was also when the whole up leg started. Okay, so once again, moving into the extreme territory, overbought or oversold, is not the signal. The signal is moving out of it again. Overall, bearish continuation seems most likely. There are no interesting downside targets, so that's why I'm simply going with the trough from April, which is at 31.2. A little bit boring. Past that, we actually have to go all the way towards the July 2024. So 1 year ago, we saw the market decline towards 30. This would be possible if we push below this 32.64 and above 34.95. Alternatively, we could make it towards 36.38. Now let's have a look at the TTF front month hourly chart. So you can see we have marked out a tentative double top question mark. So here this is like really iffy, and I would be very happy also to argue that this is not a double top, simply because what we want to see with a double top is a strong preceding uptrend, but we only had like a very weak preceding uptrend. But what a double top is in general is we see that the market is coming in from a strong up move. We have another up leg, peak is formed, nothing new here. For now it still kind of looks like the bulls will continue. So we push higher once more, and the market tops out exactly where the preceding peak was. So now we are working with two tops. What we do in this case, as the market starts to push lower a little bit, we are also marking out a line here, which is called the neckline, and a move below the neckline would then activate this or complete this double top and activate a downside target. The downside target is calculated by using the peak and the trough of the pattern. We measure the distance and then we just apply it to the breakout direction, the same distance, and this then turns into the target. So here the expectation would then be, after the bulls tried once and a second time to push higher, they failed, and eventually we made it below our preceding trough, so we are no longer making higher highs. In fact, we are making lower lows. And then we simply measure the distance from here to there in order to get our target. Now you can see where this idea falls flat a little bit on the hourly chart, because the pattern is almost happening after a downtrend, but it's also happening after a bounce past the downtrend, right? So here we can argue either way. Hey, if you want to also simply see it maybe as a range market here, you can also see it as a rectangle. I am perfectly fine with that. So what's happening here on the TTF hourly chart? So if we make a move below 33.23 this morning, then I would be inclined to draw in the target from here to there, and we apply the distance. So we would get a target near 31.82. In this case, it's not much or not really science, because we decided to not put a neckline down here. We decided to put it, where do we decide to put it? At the 33.23, right? Of course, if you're so inclined, you can also put it down here at the 33.16, which is this level there. Okay, everyone, I hope you found this useful. This is it for the week starting 7th of July 2025. It is a bit of a mixed picture, and we are working with some really clearly defined levels that would jerk us out of the sideways trend. If you do have any questions, reach out. My name is Marcello Colax. Everyone, have a good start into the week. See you around, and bye.